And if you don't fully know and understand risk as a mathematical figure in your trading, all of those dreams of compound interest are going to turn into nightmares because you don't understand the big drawdown that's coming. And you have a couple of good weeks or a couple of good months, so then you ramp up your size, and you don't know when that risk that you could have defined by your strategy, that it was going to hit you down too far. So you shouldn't have ramped up so quickly. You should have ramped up a little slower, considering the risk that was probably coming. They do this at SMB on the options desk. They're doing very well. The market's been excellent for market neutral options trading. But the reality is, their flash crash is coming. A 2008 is coming, and August 2011 is coming, and which are the harder times. And there's going to be a drawdown month. So they're always taking that into consideration on their trade size, not just ramping up the next month because last month was good. They know the pending risk. They know what's going to happen. And so that's how you pick your trade size and how big you're going to trade and what your expectation is. The second one is reward. You do have to have a positive belief and a positive mathematical and statistical outlook that you're going to have trading profits. So, and they need to be proven by looking back in time at what you've been doing, and they need to be proven in a simulated environment, and they need to be proven forward in the real world. And if you're not getting a reward, if there's not profits, you need to really, don't let psychology say, well, eventually it's going to start working, or I'm going to start tweaking things that I've never considered before and think that's going to make the difference. You have to have a positive expectation of profit. The third one is actually the term expectancy. So I kind of said expectation, but expectancy is an actual math formula that's used for your average win, your average loss times the number of each of those. And that comes down to an expectancy number. It's a very simple calculation that we could almost put this as, I can almost move this up to number one because it's such a valuable number, and there's so many other figures that systematic traders use as far as cumulative average returns, Sharpe ratio, standard deviation of returns, etc. Cumulative or expectancy is a simpler and very straightforward figure that also has the benefit where when you have a single trade on, while that trade is on, it's very, very difficult to think about the fact that this is 1 out of 1,000 trades. There's going to be 1,000 entries and exits that you're going to experience on a system or through some approach to the market. And when you look at each trade as if whether or not this one works out, or whether if 60% of the next 10 trades or 80% of the next 10 trades work, that has some kind of weight on the system.